ETF episodes are always popular, which is why we keep doing them, of course. And this is an interesting one. It's 2 new ETFs from Vanguard. So one focuses on growth and one focuses on income. So investors like both of those things.
They do. And without further ado, the 2 new diversified ETFs are the Vanguard Diversified All Growth Index ETF with the ticker symbol VDAL and Vanguard Diversified Income ETF VDIF. Both are part of their ready-made diversified funds range.
Yes. And full disclosure, Shani went to a lunch where they talked about these ETFs.
Yes.
And the CEO of Vanguard spoke.
Yeah.
He was over from the States, and you were like really into his speech.
Yeah, I felt like he had good moral fiber.
There we go. Well, hopefully that's reflected in these ETFs. So as we talked about, given that one is growth and one is income, this covers a wide spectrum of investor goals. So that's why we're doing them in this podcast. So we, of course, always talk about and advocate for understanding an investment and understanding how that investment connects to your financial goals. So we're going to go through these 2 new offerings, but also go through just multi-asset class offerings in general and what you should be aware of as an investor.
All right. So the first new ETF is a Vanguard Diversified All Growth Index ETF. That's the one with the ticker symbol VDAL. This ETF is 100% in growth assets. It offers exposure to more than 6,000 equities listed across 50 global markets, including Australian equities, global equities, emerging markets, and global small caps. Its fee is 0.27% per annum, and Vanguard believe that investors should consider this product if they've got at least 7 years to play with.
So not so much for me, but for other investors that do have longer time horizons.
I mean, you've surpassed what I thought you would. So who knows how long you could keep going, Mark?
Yeah, most of the listeners and people who comment on YouTube are hoping not very long. But Vdal is what's called an ETF of ETFs. So what that means is that this ETF is made up of several underlying ETFs. So this is a newer approach to Vanguard's ETFs, which traditionally invested in managed funds for those underlying assets. So some retail investors steered clear, and I think we did a podcast episode on this.
Yes.
But steered clear of these Vanguard multi-sector ETFs, arguing that investing in funds gives them unnecessarily high tax bill and drags on long-term performance.
So an example is the Vanguard Diversified High Growth ETF, VDHG. And Vanguard's decision to construct VDHG out of unlisted managed funds forced investors to pay the taxman and lose out on compounding. But starting July 1, they're going to change all of that. VDHG will use ETFs instead of unlisted funds.
So exciting news.
Exciting news.
So these new ETFs, of course, they're using this new approach, investing in ETFs instead of funds.
All right, so let's go down a level. There are 5 building block Vanguard ETFs in VDAL.
Which I guess I have to go through.
Yeah.
Okay, so there, of course, are Aussie shares in there. So that is invest in the Vanguard Australian Shares Index ETF. International shares, invest in the Vanguard International Shares Index ETF. And the hedged version of the same product. International small companies, which invests in Vanguard MSCI International Small Companies Index ETF, in emerging markets that still invests in a fund, but the Emerging Shares Fund.
Now, when you go through the PDS, which is a product disclosure statement.
And let's be sure, you're the only person that goes through PDSs.
Which is why you should listen to the podcast, so you don't have to go through the PDS. That's our selling point. It also shows that the ETF has the ability to invest in the fund versions of these investments. And we asked Vanguard about this because it is important to a lot of investors that the ETFs are used for those tax efficiency purposes.
And what Vanguard said was that the ETFs are always the preference. However, funds are included for flexibility. So included in the PDS for flexibility. So when asked what circumstances in which these funds would be used instead of ETFs, Vanguard responded that it may be required to use the managed funds early in the product's life due to a minimum block trade requirement for listed securities. Another instance in which funds may be used if there were circumstances during which trading via the ASX is suspended.
So although they will preference ETFs, there may be some circumstances that Vanguard will have to use funds, and the preference for ETFs means that there will likely be better investor outcomes than that previous structure that we had.
Okay, we're going to move on to ETF number 2. So this is the Vanguard Diversified Income ETF with the ticker symbol VDIF. So VDIF is focused on assets that generate income, which you could probably figure out by the name of this ETF. It has a targeted split of 60% in growth assets and 40% in defensive assets. And it is diversified into income-producing securities, 12,000 income-producing securities, which is a lot. And the underlying assets include investment-grade fixed income, corporate bond strategies, high dividend yield equities. The fee is 0.32% per annum. And Vanguard suggests that investors have at least a 6-year time horizon to invest. So also longer than I have.
I mean, it's a little less than the other one. You could give it a go.
I mean, maybe, right?
But when we look a level down, it has Aussie government bonds, Aussie credit, international treasury and credit, Aussie property, Aussie and international high yield equity, hedged international equity, and international property that's hedged. So lots of variations of income generating assets.
Yeah. And so with both of these two ETFs, they are, of course, multi-asset, which is why I read through that list of assets in the first one, and Shani just did the second one. And what this really provides investors is this one-stop shop where you just buy one ETF and away you go.
Yeah, I think, there's obviously some investors that enjoy the art of investing. I think you're more on that side, Mark.
I'd enjoy it more if my portfolio went up.
I don't think anyone's is going up at the moment, but
mine actually is because it's really boring.
Oh, okay.
Like me.
Well, there you go. There are others that treat investing as a necessary action to protect and grow their wealth and just want to simplify the process as much as possible. And I'm probably more on that spectrum.
I wrote an article saying that, which clearly you didn't read. So thank you for that. I can't even get my colleague to read my articles. But as Shani said, we do have these two different spectrums of investors, which I guess are the two of us in this little example. And the good thing about capitalism, of course, is because lots of products come out for lots of different people. And of course, it caters to different consumers and what they want. So we've seen lots of different investment products pop up that cater to this crowd that wants to invest, but really outsource the process, keep it as simple as possible. And both of these Vanguard ETFs fall in that camp, these multi-asset diversified ETFs.
But regardless of which camp you sit in, there is something to be said for a simplified portfolio. More complex portfolios make you more likely to tinker and overtrade. Over-monitoring and trading can lead to detrimental outcomes for your portfolio. And we speak about this study a lot on the podcast, but Morningstar runs the Mind the Gap study. And that looks at the difference between investment and investor returns.
Mind the Gap is my favorite Morningstar. I mean, I can only think of two of them, which isn't great because I work here. But my favorite, constant report that Morningstar puts out.
Okay.
Not into that active passive barometer thing,
There you go.
It says the same thing every time.
I mean, isn't that the point? Don't you want consistency?
You do, but at a certain point, can't you just say none of these active managers can win? And so why do we keep the score going? It's like Will's basketball team. Will's on the Morningstar basketball team. Will, our producer, and they lose every game. So it gets to the point, why show up, right?
Wow, really attacking both of us today in this podcast, Mark. But
Okay. Well, I'll get back to the study. So Mind the Gap, my favorite study. So it's conducted annually since 2010. It looks at the impact of investor behavior on investor returns. And once again, this widens and narrows, but every single time the study comes out, it shows that the more volatility there is, the larger the gap is between what an investor gets and what an investment gets. And this makes sense. So when there's volatility, and we've had some recently in the market, causes fear and nervousness in investors. And that means that a lot of investors are selling things to try to remove this pain.
And investors who don't want to build a portfolio from scratch have to walk this tightrope between these scalable investment solutions and portfolios that are customized for their goals.
And one of the challenges, we always talk about, the building blocks of portfolio, your goals, the return you need, that informs your asset allocation. But one of the problems, of course, is with asset allocation is things change all the time. If you have multiple ETFs in your portfolio, and that means you need to manage all these different things. You need to rebalance, manage potentially the minimums in terms of what makes sense to invest with brokerage. So there's a lot that you have to deal with.
Yeah, and I think, this is especially a problem for investors that do have smaller balances, where you're ending up in a situation where you might be investing $500 a month, but you'll need to do that across 5 ETFs and 3 equities to make sure that you maintain that asset allocation that you've set for yourself. And it's not really conducive to achieving strong investing outcomes. And ultimately, every investor's situation is unique. There's not really a one-size-fits-all answer.
Yeah. And, there are ways, of course, to simplify investing. You can do this by breaking down the portfolio construction process into blocks instead of individually seeking out exposure to these asset classes.
And the technical term for this is core satellite portfolio. And we've spoken about core satellite on the podcast recently when we spoke about whether investors should allocate part of their portfolio to having a punt. But this strategy was theorized before the investment industry evolved to offer retail investors so many multi-asset options.
Yeah. And once again, we did talk about this, but the basics behind a core satellite is generally the premises that passive investments do most of the heavy lifting, and that makes up the core of your portfolio. And then the satellite is where you can concentrate exposure in opportunities that you think are attractive. So that's more where you're taking active bets.
And so the industry provides these ready-made cores that help investors with lower balances that can't diversify as easily. And these multi-asset investment products are diversified across a range of assets, and it's just in one single investment vehicle.
So there is a downside of this set and forget approach, and it does make it a bit harder if you need to switch your asset allocation as the need arises. So if your goals change, if your timeline changes, things like that. So rather than simply putting new contributions into an underrepresented asset class to alter your overall allocation, you really only have one option. That's option to switch the whole asset allocation into a different risk profile.
And this often results in a taxable event, and it will impact your investment returns. There's no free lunch, and everything that's worth doing in life does require effort. Although there are some simplified solutions that investors can look for their portfolios, they still need to work on it. And monitoring and maintaining portfolios across long time horizons is needed to make sure that they're still fit for purpose for their goals. For example, investing in a 90% equity portfolio at year 1 of a 25-year time horizon, it won't be the right investments at year 24.
Yeah. And one thing, Shani used the term free lunch. If you would have read my article, you would have known where that term came from. But I'm not going to tell you. You have to read it yourself. But multi-asset vehicles, we'll get back to these ETFs. As we said, it's a great way to simplify investing, especially, I think, for new investors, Shani, that this is a really good place to get into the market. There are all sorts of different products and platforms and strategies and avenues to find the right approach for you.
And simplifying your portfolio to one ETF might not be the right strategy for you due to the inflexibility of the asset allocation that we did speak about, because it doesn't shift as your risk capacity changes over time. And the right balance between simplicity and customization may evolve over time depending on your interest in investing and the needs of your portfolio.
Yeah, but the important thing is to just invest, right? Invest as soon as possible. And I think a lot of people get caught up with the details of which ETFs do I pick? How much do I allocate to each one? And this is just a great, just
get
jump
in the market.
Yeah, just jump in. So yeah, I think both of these Vanguard products certainly are attractive for those investors. So that's everything. Anything else you wanted to add, Shani? Or are you just excited to get off this and read my article?
I'm ready to get off this and read your article.
There we go. Thank you guys very much for listening. If you have any questions or comments or any other ETFs that you want us to do an episode on, you can send it to my email, which is in the show notes.
This video has been prepared for clients of Morningstar Australasia Pty Ltd and/or New Zealand wholesale clients of Morningstar Research Ltd. Any general advice has been provided without reference to your financial objectives, situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest. To obtain advice for your own situation, contact a financial advisor.